If you're just starting out in business, you may be wondering whether you should use the single entry or double entry accounting method to do your bookkeeping. Well, it's actually a pretty easy decision to make because single entry accounting is very limited in what it can do. Double entry accounting, on the other hand, is more robust and produces much more meaningful information. So let's take a look at how each system works so you can figure out which one is best for your business. In a nutshell, the single entry accounting system records each transaction in your business with a single entry to the books. What this means is that you simply write down one number with a description for each transaction instead of having to record a debit and a credit like you do in the double entry system. And you can do this very simply on a spreadsheet or in a cash book. Let's say you use a spreadsheet. If you receive some income from a sale of your products or services, you can simply write a description here and an amount here. If you pay a bill, you can put a description of the bill here and record the amount here. As you can see, all you're really doing is making a list of your transactions. Apart from that, there's not much more to it unless you also want to track the balance of your bank account. Let's say all the transactions for your business go through one bank account. As well as recording money coming in and out from your transactions, you could put your opening bank account balance here to keep track of the ending balance here. As you've probably figured out, all we're doing by using the single entry accounting system is simply replicating the bank transactions on a spreadsheet. You've also probably figured out that you only record transactions when money changes hands. So you only record income when you receive the cash and expenses when you make a payment. For this reason, single entry accounting is basically the same thing as what's called the cash accounting system. And like I said before, the system has some limitations. What if you've done a lot of work for a few clients and sent out the invoices, but you haven't been paid yet? When you think about it, this means that your business is worth more than the balance of your bank account. You've done the work, you're owed the money, so your business is really worth the sum of your bank account plus the total amount of the outstanding invoices. And the same theory applies to bills. If you have a large unpaid bill, your business is really worth less than the balance of your bank account. You need to subtract the amount of the bill to work out the true value of your business at the time. So as you can see, the single entry system doesn't track accounts receivable, which are the invoices you're owed, and accounts payable, which are the bills you owe, and it also doesn't properly track things like inventory, loans, owner's equity, and a whole bunch of other things. This means that single entry accounting can't really be trusted to provide reliable information regarding the true financial status of your business. That's where the double entry accounting system comes in. With double entry accounting, each transaction has two sides, a debit side and a credit side, and there's no need to wait for cash to change hands to record your transactions. If you send out an invoice, you will record the revenue right away, and until you receive the money, the transaction will also be recorded in accounts receivable. Once you get paid, you will zero out the amount in accounts receivable and record the cash received in your bank account. This is, of course, just one of thousands of different kinds of transactions that can happen in a business, but no matter what the transaction, the total amount of debits entered in the books will equal the total amount of credits. And just like the single entry system is basically the same thing as the cash accounting system, the double entry system is basically the same as the accrual accounting system. So that's a quick look at how each of the two accounting systems work. Let's finish off by going over the advantages and disadvantages of each system. The main advantage of the single entry accounting system is its simplicity. It's easy for non-accountants to use, and it doesn't require sophisticated bookkeeping software. The main disadvantages of single entry accounting are assets, liabilities, and owner's equity are not properly tracked. You cannot produce a set of reliable, audited accounts. It doesn't comply with various finance and accounting regulations. It's easy to make errors due to the lack of checks and balances, and it's difficult to assess the true financial position of a business. As for the double entry accounting system, the main advantages are assets, liabilities, and owner's equity are all properly tracked. You can produce a set of reliable, audited accounts. It does comply with various finance and accounting regulations. It's difficult to make errors due to the nature of debits and credits needing to balance, and it's easy to find out the true financial position of a business by using financial reports. While the main disadvantages are, it's more complex and difficult to understand, and you may need sophisticated software to do your bookkeeping. So that's it for single entry versus double entry accounting. I hope you now have a good understanding of the differences between the two so you can decide which system is right for your business.